What do you see happening underneath the calm surface of the market?
The markets lately, in many ways, have been remarkable. Remarkable in many senses in their lack of remarkability. The relentless trend higher on moderate volume and low volatility. It just seems as though people have really gotten inured to it and view that as the normal state of affairs. And I guess if it continues long enough, it becomes that. In a paradoxical way, what we're seeing in individual stocks almost pushes you toward the more passive, broad market approach. We've seen certain stocks recently just get shot after earnings. Under Armour being one of the more recent ones. On the other hand, last Thursday into Friday, we had some real market leaders all have explosively good results. And when you have stocks that are that heavily weighted in the index, pushing it higher, the indexes have no choice but to follow. It's a mathematical certainty. If Amazon, Microsoft, Google, and Intel all rally, the markets have no choice but to move higher, particularly the NASDAQ 100. If Under Armour or Papa John's Pizza or something like that falls by the wayside, the indexes can just muddle right along because somebody else will be winning while another one's losing. It's a very tricky environment then, and I can't believe I'm saying this, but in many ways it really makes it seem like individual stock investing is almost gambling compared to index investing, which I don't think overall is a helpful state of affairs. I think you need a bottom-up view of the markets. But in the short term, if I can take my money and spread it and just put it basically in a series of index funds, many of which are having, even if you do sectorals, they're having sort of healthy sectoral rotation, energy being one of the hot ones lately. But then something else always seems to take another sector's place. So do you want to be investing in sectors of the broad market, or you want to be taking your shots in individual shares? That's a very difficult state of affairs to imagine proceeding into infinity. But in the short term, that's the situation we're living with. And it's tough to think of things that upset that apple cart. The things that could do it, of course, are the biggest one, of course, would be the process of tax reform. There's still a lot of moving parts. We've seen the dates get pushed back. I've also seen polls that show it's really not all that popular, which makes me wonder whether this rush to get this tax bill through is analogous to the rush to get Obamacare repeal through, which was basically Congress's way of trying to rush through something that was fundamentally unpopular. I think the risk here is, and I think the politicians see it as well, is that the longer this thing goes through, the more the warts get exposed, and that ultimately could be detrimental to the markets. I really think a lot of benefit of tax reform is being priced in. You could sort of see some underperformance in smaller cap indices because the perception would be those are more domestically oriented companies that are more levered to U.S. tax policy. But there's a lot of moving parts in that, and we really have to see how that one rolls out. I don't even want to venture too many predictions, except to say that if it runs into some real stumbling blocks, that could be the sort of thing that prompts a little bit of return to volatility.